Discover the optimal financing solutions tailored to support and propel your unique business model to success. Welcome to Lesson 2 of Module 7 in the Brick and Mortar Mastery course, Deciding Which Option Fits Your Business Model. Every small business needs funding at some point, whether it's to cover cash flow gaps, invest in growth, or handle unexpected expenses. But with so many financing options available, how do you know which one is right for your business? In this video, we'll walk through how to decide on the best financing option based on your business model, financial health, and funding needs. We'll cover your creditworthiness and risk profile, the purpose of your financing, how quickly you need the funds, the total cost of borrowing. By the end, you'll have a clearer idea of which financing path makes the most sense for your business. Assess your creditworthiness and risk profile. Before choosing a financing option, start by evaluating your credit score, cash flow, and collateral. These factors will determine which funding sources you can realistically qualify for. If your personal or business credit score is above 680, you'll have access to bank loans, SBA loans, and business lines of credit. If your score is below 600, you might need to look at alternative lenders, such as merchant cash advances, MCAs, or online lenders that cater to lower credit scores. Keep in mind that 84% of MCA applications get approved, while traditional bank loan approvals sit around 57%. Collateral. Do you have business assets like real estate, equipment, or accounts receivable that can serve as collateral? If yes, you might qualify for secured loans with lower interest rates. If not, your options may be unsecured loans or high-cost alternatives like MCAs. Lenders will check if your business generates enough revenue to cover loan payments. A common metric is the debt service coverage ratio, DSCR. Lenders prefer a DSCR above 1.2, meaning your business earns at least 1.2 times the amount needed to cover debt payments. If your cash flow is unstable, loans with fixed monthly payments could be risky. In this case, a line of credit or revenue-based financing may be a better fit. Match the loan to your business needs. Different financing options serve different purposes. It's important to match the loan type to your specific business goal. Short-term needs, cash flow gaps, seasonal fluctuations. Best option, business line of credit. Works like a credit card. Borrow what you need and pay interest only on the amount used. Great for managing seasonal dips or unexpected expenses. APR typically ranges 6 to 10%, much lower than merchant cash advances. Avoid long-term loans for short-term cash flow issues. You don't want to be paying off debt long after the need has passed. Long-term investments, expansion equipment, real estate. Best option, S loans or bank loans. SBA 7A loans go up to $5 million with repayment terms of 10 to 25 years. Interest rates around 9% to 11%, much lower than alternative lending. Perfect for buying property, opening a second location, or purchasing expensive equipment. Avoid MCAs. Daily repayments can be too aggressive for long-term investments. Emergency funding, unexpected repairs, sudden opportunities. Best option, online lenders or business line of credit. Some online lenders provide approval in 24 to 48 hours. Interest rates are higher than banks but lower than MCAs. Avoid high-interest merchant cash advances unless absolutely necessary. Consider speed of funding. How quickly you need money is a major factor in your decision. Traditional bank loans and SBA loans take weeks or months to process, so they're not ideal for urgent needs. Online lenders and business lines of credit often approve funds within days, making them a good middle ground option. Merchant cash advances can deposit funds within 24 hours, but at a high cost. If your business has the time to plan, slower funding sources like SBA loans will save you a lot in interest. If you need money immediately, be cautious about high-cost options. Compare total borrowing costs. Not all loans cost the same, and it's important to compare the total amount you'll repay. Look at the APR versus factor rate. Bank loans, SBA loans, and lines of credit use APR, annual percentage rate, which can be as low as 6 to 12%. MCAs use a factor rate, typically 1.2 to 1.5, meaning if you borrow $10,000, you'll owe back $12,000 to $15,000, regardless of when you pay it off. When converted to APR, MCAs often exceed 100% or more in interest costs. Monthly payment versus daily payment. A $50,000 SBA loan over 10 years at 10% APR, $660 per month. A $50,000 MCA with a 1.4 factor rate, 200 plus deducted daily, often leading to major cash flow strain. Avoid getting trapped in high-cost debt by choosing the lowest cost financing you qualify for. Thank you for watching. The right financing choice depends on your business model, cash flow, and urgency. If you have strong credit and need long-term funding, SBA or bank loans are best. If you need flexible, short-term financing, a business line of credit is ideal. If you need money fast, online lenders can be an option, but compare costs carefully. Avoid expensive MCAs unless absolutely necessary. Before applying, check your credit, calculate total borrowing costs, and ensure you can handle repayments.